Welcome back. In this session, we are going to explore an essential step in accounting, the trial balance and how it transitions into financial statements. Before businesses can prepare their financial reports, they need to ensure that their records are accurate. That's where the trial balance comes in. Why is this important? The trial balance acts as a checkpoint. It summarizes all the ledger accounts and verifies that total debits equal total credits. This ensures that financial records are balanced before preparing financial statements. What will we cover in this session? In this discussion, we will cover what a trial balance is and why it matters, how to prepare a trial balance, how it serves as the foundation for financial statements like the income statement and the balance sheet. Why you should learn this? Mastering this process is crucial because financial statements are used by business owners, investors, and decision makers to assess a company's financial health and make strategic decisions. So, what is next? So, let's dive into the trial balance, its purpose, preparation, and how it connects to the bigger picture of financial reporting. Now that we have introduced the trial balance, let's take a closer look at why it is such an important step in accounting. In any business, maintaining accurate financial records is critical for decision making and business transparency. Without accurate records, companies risk making poor financial decisions or facing compliance issues. The trial balance serves as a checkpoint to ensure that total debits equal total credits before financial statements are prepared. This verification process helps accountants detect errors or discrepancies before moving forward. By preparing a trial balance, businesses can confirm that their books are balanced and ready for financial statement preparation. It ensures that all financial transactions have been recorded properly and that the financial reports reflect accurate information. In the next sections, we will explore how a trial balance is prepared and how it transitions into financial statements. Let's dive in. A trial balance is an essential bookkeeping report that provides a summary of all ledger accounts at a specific point in time. It serves as a checkpoint to verify that total debits equals total credits, ensuring the accuracy of financial records before moving on to the financial statements. So, what is the purpose of a trial balance? 1. Trial balance ensures that debits equal credits. This follows the fundamental accounting equation, which is assets is equal to liabilities plus the equity. Any imbalance indicates a possible error that needs to be corrected. 2. Trial balance also identifies errors in journal entries or posting. By checking the trial balance, accountants can spot mistakes in recording transactions before they impact financial statements. Third, trial balance also provide a snapshot of account balances. The trial balance give an overview of all financial accounts, making it easier to prepare financial reports. In the next session, we will discuss how to prepare a trial balance and how it plays a key role in the transition to financial statements. Let's continue. In preparing a trial balance, the first step is to list all ledger accounts from the general ledger. The general ledger is the main record where all financial transactions are categorized into specific accounts. Each account is given a unique account number and classified based on its type, like assets, liabilities, equity, revenue, and expenses. In our example, 1 is classified as our asset, 2 as our liabilities, 3 is our equity, and so on and so forth. For example, cash, accounts receivable, accounts payable, revenue, salaries expense are accounts that is found in our general ledger. So, to initially create our trial balance, it is important to list down all of these accounts that are found from our general ledger. By listing all ledger accounts, we ensure that every financial activity is included in the trial balance. In the next step, we will record the corresponding debit and credit balances to verify accuracy. Let us move forward. Now that we have listed all ledger accounts, the next step is to record the debit or credit balances for each account. Each account has either a debit or credit balance, depending on its classification. Assets and expenses normally have debit balances. Liabilities, equity, and revenues typically have credit balances. In our example, cash, accounts receivable, and inventory have debit balances. Accounts payable, long-term debt, and revenue have credit balances. At this stage, we ensure that each account's balance is accurately recorded in the correct column. The next step is to total the debit and credit columns and verify that they are equal. Let's proceed. In this final step of preparing a trial balance, we total the debit and credit column to check if they are equal. In our example, the total debits amount to $2,350 and the total credits also amount to $2,350. This confirms that our trial balance is balanced, meaning that the accounting equation holds assets is equal to liabilities plus the equity. If the totals were not equal, we would need to review our entries for possible errors such as misplacing a debit or credit, omitting a transaction, or recording incorrect amounts. With the trial balance verified, we can now move on to preparing financial statements. Even when the trial balance appears to be correct, it is essential to check for possible errors before proceeding to financial statement preparation. Here are three key steps to verify accuracy. 1. Review ledger postings. Ensure all transactions from the journal are transferred correctly to the ledger and the trial balance. 2. Look for missing or duplicate transactions. A missing or repeated entry can cause an imbalance. 3. Verify correct placement of debits and credits. Errors often occur when amounts are placed in the wrong column, impacting account balances. A balanced trial balance does not always mean there are no errors. Sometimes mistakes, such as recording the wrong amount in both debit and credit, may still exist. Once all checks are complete, we are ready to move on to the next step, which is preparing our financial statements. Now that the trial balance confirms our debits and credits are equal, we can move forward in preparing the financial statement. The first financial statement we prepare is the income statement, which summarizes the revenues and expenses to determine the business's net profit or loss. From the trial balance, we extract all income and expense account. Revenue is listed first. In this case, the business earned $900 in revenue. Cost of goods sold or COGS is subtracted to determine gross profit. Here, cost of goods sold is $350, resulting in a gross profit of $550. Next, we deduct operating expenses, the salaries, taxes, and other expenses. After these deductions, we arrive at a net profit of $210. This net profit will later be used in the next financial statement, which is the statement of changes in equity. Now that we have the income statement completed, we can now move on to the next step. Now that we have completed the income statement, the next step is to prepare the statement of changes in equity. This statement tracks how the owner's equity changes over time, incorporating profits and some withdrawals. First, we begin with the equity at the beginning of the period, which is $350. Then, we add the net profit from the income statement, which is $210. If there were any withdrawals, we would subtract them, but in this case, there are no withdrawals. After adding everything together, we arrive at the ending equity of $560. This final equity amount will now be used in the balance sheet, our next financial statement. Now that we have completed the statement of changes in equity, it is time to prepare the balance sheet, which provides a snapshot of the company's financial position at a specific point in time. To create the balance sheet, we follow these steps. First, list all assets. These include cash, accounts receivable, and inventory, totaling $1,660 in this case. Second, list all liabilities. These include accounts payable of $400 and long term debt of $700, totaling $1,100. Third, include the owner's equity. We take the ending equity from the statement of changes in equity, which is $560. Verify the balance sheet equation. The sum of the liabilities and equity, which is 1,100 plus the $560, must equal to the total assets of $1,660, ensuring the balance sheet is balanced. This balance sheet provides an overview of the company's resources and obligations, essential for financial decision making. With this, we have now completed the financial reporting process, successfully transitioning from the trial balance to the financial statements. As we wrap up our discussion, let's take a moment to reflect on the importance of the trial balance and its role in financial reporting. A trial balance is not just a routine step, it is a crucial checkpoint to ensure accuracy and completeness before financial statements are prepared. Without it, errors in journal entries or postings could go unnoticed, leading to incorrect financial reports. The financial statements derived from the trial balance provide valuable insights into a company's financial health. They help businesses assess their profitability, financial position, and cash flow, guiding decision makers in planning and strategy. Most importantly, each financial statement is interconnected. The income statement determines net profit, which then flows into the statement of changes in equity and ultimately impacts the balance sheet. This structured process ensures transparency, consistency, and reliability in financial reporting. By following this approach, businesses can accurately evaluate their financial performance and make informed decisions for future growth. Congratulations! You have successfully completed this series of pre workshop video lectures. Through this journey, we have covered the fundamentals of trial balance, the posting, journalizing, and the financial statements. equipping you with essential knowledge to understand financial records with confidence. By now, you should have a solid grasp of how financial transactions are recorded, how they transition into financial statement, and why accuracy and consistency are key in accounting. This is just the beginning. In our final workshop, we will take this knowledge further, applying these concepts in practical scenarios, discussing real world financial analysis, and answering any questions you may have. So, once again, congratulations on reaching this stage. Thank you for your time and commitment. See you at the final workshop. Bye. This is Ken Enriquez, Atlas Corp Scholar and Australia Awards Scholar and the ASOC President. See you in the workshop. Bye!